This make-or-break hour begins with markets on edge as a critical week gets underway. Clearly, the events in the Middle East have introduced a new level of risk for investors, but markets, they are strengthening as we move into this final hour. Take a look at your scorecard. With 60 minutes to go in regulation, we're at the highs of the day across the board. And that's despite those geopolitical concerns. Even the NASDAQ, which was the big loser earlier, has turned around. It's good for 0.5%, but everything right now is in the green. That ahead of earnings and important inflation data still to come later in the week. So there's a lot still ahead of us, obviously. Also worth noting today, the bond market's closed. But importantly, bond futures suggest some much-needed rate relief could be on the way tomorrow as yields look as though they'll be decidedly lower. It'll be interesting to see, of course, how that cycles through the equity market, but perhaps some of it already is, as we showed you what the stock market is doing, perhaps in part based on what's happening in the futures market, at least as it relates to bonds. Takes us to our talk of the tape, the risk-reward for your money and whether it's about to get better, as some are suggesting. Let's ask Adam Parker. He's the founder and CEO of Trivariate Research, a CNBC contributor, with me, as you see, at Post 9. Interesting turn in the market.
Yeah.
Do you think it is in part because of what the futures are telling us that bond yields could do tomorrow and we'll get some relief?
I think so. I mean, you always have these weird days when the bond market's closed and the equity market's open. The value of a lot of the growth stocks, as you alluded to, is, correlated or associated with the perception about rates in the future. And I think when you get a risk-off trade, the 10-year yield usually goes lower. And so some of these things could get a little bit of a bid. And I also think that, frankly, a lot of investors believe, the consensus view among institutional investors is we're going to end the year higher. That they're behind on the 12, 13% we're up in the S&P. They're behind on the 20-something% we're up on the NASDAQ. They didn't really allocate as much to equities as they should have at the end of the year. And I think people are going to chase a little bit. And frankly, what are we, October 9th? We didn't get any major negative pre-releases yet. Usually you'd get, if things were worrisome on the earnings front, you'd get some kind of mess in the first 7 or 8 days. So I think people are thinking earnings are going to be okay and guidance is going to be okay. And maybe we could be sort of off to a bit of a rally based on fundamentals.
What about this new geopolitical risk that was introduced over the weekend? Sort of always in the background, but now it goes on the hot boil and we have all-out war.
Yeah, I mean, when you have a risk-off trade in that sense, typically the businesses that do the worst are the ones that have poor free cash flow and poor free cash flow conversion. So by conversion, I mean the earnings, like how much of the net income gets turned into free cash flow. So we put out over the weekend ideas that you want to short or ideas you want to avoid owning where they have poor free cash flow attributes and poor conversion. I think that makes sense, but I'm looking at the market here thinking, gosh, I see a lot of things I want to own and a lot of things that seem oversold. For the first time in months, I was looking at Truist today thinking, gosh, that stock's down to March 2020 levels. Does that make sense? I mean,
financials have gotten crushed here.
Crushed.
You look at like the KBW,
absolutely crushed,
example,
and I'm like,
it tells a really tough story.
Right, and you look at those things thinking, all right, there's a 7.5% plus 7.6 dividend. They've got a pretty solid geographical footprint, and unless something really goes wrong with the fundamentals, should stocks be at the March 2020 level? I'm just, I'm looking around thinking maybe there's some things to own, so I'm not as negative as
rates going up the way they did in September was something really going wrong with the fundamentals. I mean, obviously bank stocks started to do worse as rates started to shoot up. You start worrying about financial conditions and credit and everything else.
I'm looking forward. Like we've been underweight banks all year. I'm just saying from here, for the first time literally all year, I was looking at stocks earlier today thinking there's a bigger recession and some more negativity embedded in those stocks than there are in other parts of the market. So it's more of a relative thing.